Welcome back. IndusInd Bank's first quarter numbers are picture perfect. Loan growth at over 21%, best in 4 years. Margins at 4.29. Well, Abhishek tells me it's the best in 8 years, but that's because we don't have data beyond it. It's probably an all-time high. I have with me Sumant Katfalia, Managing Director and CEO of IndusInd Bank. Sumant, good morning, and thank you very much for sparing time for us.
Good morning.
This is a journalist's nightmare because we like to ask tough questions, but it's really tough to see anything difficult over here. So, first, the plain vanilla question. 21% is a very good loan growth. Is this a maintainable pace? Are you seeing enough demand on the ground?
So we do see enough demand specifically in our domain. So if you look at our growth, our vehicle finance unit came in at a very good growth of 21% year on year. I think our microfinance came in at 14%. Our other retail came in at 27%, driven by unsecured as well as merchant acquiring business, which has done very well. And of course, our corporate bank, specifically in the SME and the MSME side, gave a 10% quarter-on-quarter growth. So I think this was broad-based. We believe it's sustainable because we play in those businesses where we have a right to win, and we believe that that's going to drive the growth as we move forward.
Okay. Among the businesses you are best known for is vehicle financing. One almost looks at it almost synonymous with IndusInd. Now, when we spoke to the CV guys, and even when you look at the May-June numbers that were announced, there is clearly a downturn, a slowdown. I won't say downturn, slowdown in CV sales. In PVs, compact cars have done actually badly. Only SUVs have done well. And two-wheelers, we all know that everyone's rushing to the 400cc plus because the lower segments are doing badly. So is it going to be a fight there to be able to produce a 20%, 21% loan growth?
So what you will see, we are well diversified in our vehicle finance portfolio. We have 6 categories of vehicles where we play in, and CVs is one of them. You're absolutely right. I think the growth will be tapered to around 8 to 10% this year. And I think if you look at, and that's on the volume side, but if you look at the price variance, that will be another 8 to 9%. And if you're gaining market share, so we're very confident that we will maintain our growth rate at that level because of the price variance, the volume variance, and the gain in market share, all playing together.
I take a point on price variance because even Maruti is telling us SUVs are doing well. The high-priced ones, premiumization is the name of the game. So yes, I take your point on that. But speaking of claiming market share, we now have a behemoth in HDFC Bank, which is going to aggressively look for deposits. Of course, this quarter they didn't because they had overdone in Q4. But, they have to replace the HDFC maturing liabilities and want to grow their own, 20 lakh crore balance sheet with alacrity. So costs will go up. You think this is the best you can do in margins? Does it get better than 4.29?
So we've always said our margins will be range bound between 4.2 to 4.3. That's been our direction to the market, and I think we believe that that's the right margin in which we will play in. Of course, our cost of deposits are high, and we believe that the cost of deposits will start coming down in Q1 of next year, and you will start seeing the decline in the cost of deposits as we move forward.
Yeah, but that's provided HDFC Bank allows. Isn't it? That's something which bankers keep mentioning, keep whispering.
Lata, there has always been competition.
Right.
Every bank will have their own unique strategies to garner deposits. If you think that we copy the big banks, I think our cost to income ratios will fall flat. So we have to do things differently. And if you would look at our affluent business, the NRI business, I think we are gaining market share. Our home markets, we've gained market share. So we play in different markets, we play in different segments and gain market share on those segments.
Okay. No, fair enough. It's just that, because it's a big player, second largest bank, it has an impact on the industry itself, which is what bankers worry about. The other point is, can you tell me what is your fixed to floating loan percentage? How much of the loan is floating?
So 48% of our book is floating and 52% of our book is fixed.
Okay. Now, in a context where Reserve Bank rate hikes have peaked, this might work to a disadvantage in terms of you not being able to price your loans higher and therefore a pressure on margins?
See, I've been hearing this discussion on pressure on margins for the last 6 quarters. And if you go back and see our margins, it's been very consistent between 4.25 to 4. The beauty about our book is it's self-balancing. And now the retail book, if the cost of deposits go down, the retail book will start giving higher margins because we book the loans at a higher yield at this point of time on the fixed rate book.
Okay.
And that will start playing out.
Yeah, your 52% will certainly come to your help. Of fixed rate loans. Sumant, yes. There have been repeated warnings from the Reserve Bank on unsecured loan book, and just recently there was a CRISIL press release, CIBIL press release, which was indicating some pressure with credit card loans. Of course, this is a dated report. It dates to the period ending March 31. But still, if the trend has continued, there is a problem with unsecured loans, and Reserve Bank is sent out those letters to NBFCs and banks. Do you think that we should worry about what is growing very well for you, unsecured loans?
It's look at the business. While the percentage growth may be higher, the unsecured, which is non-MFI book, is only 5% of our book, which is credit cards and PL combined. So we've always been static on that growth. Of course, we are 4.2% and we've gone to 4.8 or 5%, but that's where it will be. So we have always been consistent in our commentary that because we have an MFI book, which is at least 12 to 13% of our book, our unsecured businesses other than MFI will be 5% of our book, and that's where we are on this book. So we don't have such a big exposure on cards and PL as what the market seems to be, because we are not growing that book very rapidly. When you see a percentage growth, it is coming from a very small base, and that's why you see the percentage growth.
Okay. How are you looking at the year ahead, the next 3 quarters? What are likely to be the growth levers for you? And for that matter, even profit levers?
So I think there are 3 levers which will drive our growth. One is, of course, the loan growth, and we've always said our loan growth will be in the range of 18 to 23%. Our domains are coming from cyclical lows, and we believe our domains will continue to give us growth. We've not grown our microfinance book last quarter, and you will see that growth coming back this quarter. New additions of products which we've added will also give us growth, like merchant acquiring business, mortgage business, and I think you will start seeing that growth. Number 2, I think our cost of deposits will start tapering down. I think from Q3 onwards, you will start seeing a smaller decline in the cost of deposit, but by Q4 of this financial year, you will start seeing, and that will start increasing the margin. And the rest we've said is our credit cost will be between 110 to 130 basis points. So we still have a way to go. We are at 132. We should be at 110 to 130. And of course, the operating leverage, which is the cost to income ratio, will settle down at 45% for this year against 45.6 which we provide. So if you look at it, we're heading towards a 2% ROA business, and those are the levers which will play for us.
Yeah, and you are carrying a contingency buffer as well. So I guess there is still some elbow room for a lower credit cost. Sumant, this is more an industry question as a bank, as a veteran in the sector. Do you see major disruption because of Jio Finance on the one hand? It's coming possibly with a 5 lakh crore ability to lend, a 1 lakh crore net worth. I mean, all this is just looking at the kind of capital they have. Is that likely to be disruptive and, push down the rates, undercutting possible?
So competition is always healthy. It depends on which segments you are playing. I've always said lending business is not a prepaid business, it's a postpaid business. You have to collect what you lend. So I think every lender has understood that while it is easy to grow the book, the balancing of the portfolio and the quality of the portfolio is what sustains the business.
Sumant, I'm really sorry I have to interrupt. I'm sorry I have to interrupt you. We'll hear more about that. But Sumant has very patiently waited by. Sumant, apologies if we can't compete with the Prime Minister, can we? We had to cut it over there. The one thing I wanted to ask you, the market is very kind to those who are seeking capital now. We just saw federal raising. You're well capitalized, but would you still want to dip in and take advantage of a kind market?
I don't know. I think if you look at what our risk weights are and the way they're going, we've actually increased our capital over the last quarters because our risk weights have gone down. And I think as long as we do that, and as long as our internal accruals are enough to take care of the profitability, it is better that we don't raise capital. If we have an opportunity where we see an acquisition opportunity or an inorganic opportunity which actually adds a fourth domain, then we will go to the market at the right time. But today, I don't see that need of raising the capital as of now.
Will that acquisition, your sights be? Is it NBFC? Is it anything?
Can't comment on it, Lata. That's very confidential. But whenever we've done an acquisition, three principles play. It has to be ROE accretive. It has to be complementary to our portfolios which we have. So we have 2 domains or 3 domains. It has to be complementary to that. Or it introduces a new line of business which we want to be in.
All right. Fair enough. Unfortunately, out of time. Thank you very much, Sumant, for your patience. Sumant forestalled some of my questions. I was going to ask about the risk weight assets going down. Clearly, that's giving them more capital, and they will look for capital if they look for acquisitions. That's a very big takeaway from this interview. Wrap up on Bazaar, an extended one. Apologies to the Chartbusters team. It's coming up for you in just a minute.